and welcome to the latest investment market update. I hope you're all keeping well as we move into springtime. I'm Brian Morman, Chairman of Brunsdon Financial, and today I'm being joined once again by Mark Shields, Investment Director at Brooks Macdonald. Brooks Macdonald have been carefully selected to manage the Brunsdon investment funds, and using their expertise, the team analyse movements within the market and make tactical changes. Mark, the world order, as we have become accustomed to, is being constantly challenged of late. Let's talk about how these changes affect us financially. Some markets have been weaker recently. What, in your opinion, has been the driver for this?
Yeah, hi, Brian. Yeah, you're absolutely right. We have seen quite a bit of market weakness over the sort of start to 2025. I think markets globally at least peaked in around about sort of mid-February time, I believe, and have suffered some fairly severe pullbacks since then with some smaller rallies as well. But there has been quite a bit of consternation in markets. A lot of this is stemming really from the sort of much more aggressive and blanket tariff regime that the Trump administration seems very willing to adopt or to impose, and going much further than maybe people anticipated back in sort of November, December time when Trump actually won the election. That started to cause quite a few sort of implications for markets, but also economies. So we're seeing a slightly larger question being asked as to whether the strength of the US economy is going to remain intact in the face of these tariffs, but also obviously the impact globally as well, and the economic and inflationary impact that is likely to have kind of across the board, really. So there's quite a lot of questions now being asked and quite a lot of uncertainty. It's still very much debatable as to whether this is just the start of a negotiating tactic or whether this really is something that Trump is going to sort of see through thick or thin, as it were. But certainly in the near term, investors and markets have been rattled.
So, looking specifically at the Brunsdon portfolios, which assets at the moment have been more or less exposed to market weakness?
Yeah, it's been a bit of a mixed bag in some ways, if I'm honest with you. So we are quite underweight, even though actually we are playing technology as one of our themes. We are actually slightly underweight parts of the technology market, such as the Magnificent Seven, those mega cap tech names. We've got roughly half weighting to those names in the Brunsdon Adventurous fund at the moment, and that's been a fairly reasonable positive, largely because those big tech names have come under the largest selling pressure. They were off by around about 20% or so since their peak at the end of last year. Now that is largely because of their very high valuations. Obviously, there is some consternation around them, but equally, you tend to find that when markets turn, investors kind of sell their most expensive assets first, and in this case, that was the Mag 7. So that's been a definite positive, our relative underweight to the Magnificent Seven, those mega cap tech names. Also, our overweight to the UK has been quite positive as well. The UK's held up quite nicely, actually. It's broadly flat year to date, whereas the S&P 500 is down by around about 7, 8, 9%, something along those lines. So our overweight to the UK, whilst it has been a drag for a little while, it goes to show that actually there are opportunities away from the US, and indeed it is a part of the portfolio that has performed relatively well in light of what's been going on. We've also had reasonable returns from areas like healthcare, US value, alternatives have done well as well, providing us with some protection against some of those market moves. On the more negative side, we've got exposure to US smaller companies. We're quite overweight US smaller companies at the moment. Our logic for adding those back in the early part of 2024 was that we felt that the US economy would remain strong. So this sort of move that we've seen very recently, where investors have started to question the strength of the US economy in light of the tariff risk, has hit those US smaller companies particularly hard. So that's a little bit frustrating. We've also, in the cautious fund at least, we're also remain overweight short-dated fixed income. Now that's been good. It hasn't really sort of negatively impacted the portfolio, but it hasn't performed as well as long-dated fixed income that has sort of rallied. The idea of these assets being more of a safe haven have performed a little bit better than short-dated. So on a relative basis, that short-dated defensive fixed income has lagged somewhat. But I would hasten to add that if we do see these tariffs come through, they're almost certainly going to be inflationary, and those long-dated bonds are the most exposed part of the bond market to a secondary inflationary spike. So we're very comfortable remaining shorter duration within that part of the market at the moment.
Okay. And whilst you've touched on it, with your crystal ball, where do you see markets going from here, Mark?
Yeah, obviously it's a very, very difficult one to answer. Clearly, the big question really is going to be, what the Trump administration's objectives are for this tariff policy that they are looking at the moment. As I'm speaking to you at the moment, right now, this is, kind of the dawn of what Trump has sort of billed as, Liberation Day. So I suspect we will probably know a little bit more with regards to what his policies are going to be, come this evening. I believe he's meant to be doing a press announcement, but probably just as importantly, really, we may need to wait a little bit longer to see what some of the counter impacts are going to be, what the EU does, maybe what China does, maybe what Canada, Mexico do, all of these places that have been sort of targeted by Trump, what their response to this tariff policy is going to be. And whether we are going to sort of encounter some sort of quite severe trade war, or whether this is simply kind of the start of Trump using this as a bit of a negotiating tactic to try and carve out some better deals as he perceives it for the US. But I think for the time being, we're relatively comfortable with our portfolio positions. We don't have a tremendous amount of exposure to the most sort of exposed assets, as it were. We are a little bit overweight to parts of the market globally, at least, that have been more resilient, and we would expect to potentially remain more resilient. So for the time being, at least, I think that we're comfortable with our positioning, and we don't really think this is the time to be swinging the investment bat, as it were, despite markets having come under a bit of pressure recently.
Okay, Mark, well, thank you very much for that. And once again, thank you for watching. If you have any questions or queries, please be in touch with us. Thank you.